Would government backing go away if the new Trump administration did privatize Fannie Mae and Freddie Mac? And would you continue to buy agency bonds? Hello, members, super savers, and bond course fans. I hope you're healthy and well. Welcome back to part 2 of our 2-part Trump and your agency bond series. Here are the 3 topics that we'll be covering in today's video. 1. Who's pushing for privatizing Fannie Mae and Freddie Mac? 2. Privatization. Is it possible, and at what price? And 3, what happens next, and what should agency bondholders do now? If you missed the first part of the series or want a refresher, I've linked part 1 in the first pinned comment below this video for reference. In part 1, we covered these topics: why Fannie Mae and Freddie Mac are so important to our country, what they do exactly as mortgage wholesalers, and why the government took them over in 2008. For the lifelong learners amongst us, I highly recommend watching part 1 first, as it will help you better understand Fannie Mae and Freddie Mac's bankruptcy, how we got to where we are today, and the current privatization proposal's potential impact on your agency bond holdings. Plus, as I mentioned in part 1, it's also a fascinating piece about how the government wants to help as many Americans as possible to buy their own home, and how this is not always as straightforward as it seems. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Who's pushing for privatizing Fannie Mae and Freddie Mac? As those of you who watched part 1 of this series already know, Fannie Mae and Freddie Mac, or Fannie and Freddie for short, are still in conservatorship at the time of this taping, meaning that they are majority owned and controlled by the federal government. And over the past 16 plus years, since their nationalization, when they were put into conservatorship, the secondary mortgage market has slowly recovered from the depths of the great financial crisis of 2008. Everything seems to be functioning okay at the moment, or at least we haven't heard about any special dysfunction. However, there has been talk about re-privatizing Fannie Mae and Freddie Mac since at least the first Trump administration back in 2016. And the talk is now ramping up again as the new administration is preparing to take over in the next few days. From what we can see, there are 3 drivers for this latest round of Fannie and Freddie reprivatization discussions. First, Fannie and Freddie have, over time, dug themselves out of their bankruptcy hole and are profitable companies again. In the third quarter of 2024, they both showed a healthy net income, profit, of $4 billion for Fannie Mae and $3.1 billion for Freddie Mac. Second, like back when they were first privatized and listed on the stock market, Fannie in 1970 and Freddie in 1989, there is a fundamental conviction among some decision makers that it's not the role of the federal government to run a large and profitable bank and securities house forever, for all the reasons of competition, entrepreneurship, and so on, as well as a desire to remove Fannie's and Freddie's large balance sheets from the federal government's accounts. Recall from part 1 that in terms of total assets, Fannie is the largest company in the U.S., just ahead of JP Morgan Chase, and Freddie is the 3rd largest company in the U.S., just behind JP Morgan Chase. And third, and maybe even most important, there has been a strong push for privatization recently from Bill Ackman, the founder of Pershing Square Capital Management, and a well-known outspoken investor. Ackman had bought a lot of Fannie and Freddie shares at about $2.40 on average on the OTC market, and thinks they could be worth more than $30 per share when privatized and properly relisted on the stock exchange, which could net him as much as 1,200% profit on the trade if successful, according to Bloomberg. So for Ackman, privatization sounds like a personal win, given his Fannie and Freddie stock holdings. But does it really make sense when we pull Ackman's personal motivation out of this equation and consider just these 2 drivers alone? Which brings us nicely to the second privatization question for today's video. Privatization. Is it possible, and at what price? Privatizing Fannie and Freddie is clearly possible. It's been done before, and even the outgoing Biden administration seemed to concede as much when the Treasury Department and the Federal Housing Finance Agency recently published a roadmap for privatization for Fannie and Freddie. That said, Trump, who will take the White House again in less than a week at the time of this taping, hasn't publicly spoken on the issue yet. In fact, he has not talked about Fannie Mae and Freddie Mac at all during his campaign this time around, nor has he said anything directly since his election. As Carolyn Leavitt, spokeswoman for the Trump transition team, has often been heard saying these days, no policy should be deemed official unless it comes directly from President Trump. Any privatization would also be a long process and not happen overnight. Here are just a few of the tough questions that would need to be resolved. What will be done to ensure that investors will trust a newly privatized Fannie and Freddie? Meaning, will investors demand an explicit U.S. government guarantee for Fannie and Freddie bonds to be sellable? What mechanisms will be put in place to make sure that Fannie and Freddie won't blow up again in the next real estate crisis and then have to be saved once more with taxpayer dollars? What problem will privatization really be solving? Meaning, what will be made better? And can the idea genuinely be sold to the American public and all stakeholders involved, and not be viewed just as a giveaway to Trump's rich friends? And the most pressing question, perhaps, at what price would Fannie and Freddie be privatized? And how much upside would there be for the government and current shareholders? This last one is especially complicated. Bill Ackman on X shows a few simple numbers and states that privatization of Fannie and Freddie would be good business for both the federal government and for current private shareholders. Here's why. The federal government saved Fannie and Freddie with a $190 billion rescue package in 2008, and they have already been repaid about $301 billion in cash for it, so they've already made a tidy profit. On top of that, the privatization could generate another $300 billion in additional profit to the government from the sale of their common shares. Remember, the government owns 79.9% of common stock. And as a bonus, the combined liabilities from Fannie and Freddie of almost $8 trillion could be removed from the government's balance sheet. Ackman makes a straightforward case and may even have a point, but it's not that simple. Under the current terms of the bailout, after several revisions and amendments since 2008, the government, from a financial and economic perspective, owns all of Fannie and Freddie and then some. So privatization could be a good trade for the government in any case, but it's not clear they have to share the upside with private investors, including Ackman. It's very technical, but in essence, this entire $301 billion in cash that the government has received so far for its bailout, it's considered like a dividend or interest payment on their initial $190 billion rescue package of preferred stock. Recall from part 1 of our series that the rescue package technically came as preferred stock. And essentially, none of this cash was ever allowed to be used to pay down the preferred stock. Remember this point, it's important. That said, we won't go into the nitty-gritty details here because it's the kind of thing even accountants would have nightmares about. But you can get an idea of what we mean here on Fannie Mae's balance sheet from September 30th, 2024. And it's the same basic situation with Freddie. The line total stockholders' equity shows that Fannie has a positive equity value of $90 billion that belongs to shareholders. So this would be a good starting point for privatization and some upside for shareholders. And remember that the government owns 79.9% of the common stock, and private shareholders, including Ackman, own about 21.1% of the common stock. So both sides, the government and private shareholders, could divide the spoils of privatization among themselves, so to speak. But, as so often, the devil is in the details. This line, senior preferred stock here, shows that the government owns a bit more than $120 billion in preferred stock in Fannie Mae. That's essentially the part of the $190 billion bailout that went to Fannie Mae. And Freddie Mac's balance sheet shows the remaining $70 billion. And like we just said, remember that under the current terms of the bailout, Fannie, like Freddie, will never be able to repay these loans or retire the senior preferred stock, to use the technical term. So this $120 billion will stay with the government forever, even if Fannie gets privatized, even though Fannie has already paid $301 billion in cash to the government under the terms of the bailout, as Ackman reminds us. But it gets worse for private shareholders. This note here, next to senior preferred stock, shows a liquidation preference of about $208 billion, $207.982 billion to be exact. That sounds very technical, but in essence, what this means is that the government owns even more in preferred stock than the $120 billion as notionally shown on the balance sheet. And that additional stake of the government that makes up the liquidation preference comes, to explain it a bit simplified, from the fact that the government has not only been collecting all the cash that we mentioned before as interest payments, but it has also added any profits that Fannie has been making to its ownership stake. So yes, in return for having bailed out Fannie and Freddie back in 2008, the government, even now, gets a lot of interest in cash, plus they also get credited with any net profits that the companies make. And yes, the government did get a great deal, in hindsight. Because Fannie and Freddie are currently profitable, the liquidation preference of the senior preferred stock keeps growing, as any increase in the firm's net worth is being credited to the senior preferred stock, and hence the government, as Fannie discloses in the latest public filing from September 2024. The aggregate liquidation preference of the senior preferred stock will further increase to $212 billion as of December 31st, 2024, due to the $4 billion increase in our net worth in the third quarter of 2024. What this means is essentially that the $4 billion in net income from Fannie Mae in Q3 of last year will increase the aggregate liquidation preference, the government stake, so to say, from about $208 billion here to about $212 billion for the next quarter, as you can see here. Basically, the more profitable Fannie and Freddie are, the more this liquidation preference grows. Put simply, the terms of the bailout meant that the government gets nearly everything that Fannie and Freddie make, and there is limited direct upside for the remaining private shareholders. You could call that harsh, but the fact remains that if the government insists on collecting these liquidation preferences in full, as they have every right to do under the law, they could of course still privatize Fannie and Freddie, but the total stockholder value of about $90 billion would go deeply into the red after we deduct the liquidation preferences, meaning that all the upside of a privatization would go to the government and basically none to Ackman and other private stockholders. Not surprisingly, Ackman thinks this is fancy accounting and a bit unfair that the government has already been paid so much in cash and is still taking credit for all other profits on top, and that Fannie and Freddie still have to keep paying and paying while the government basically owns everything and then some. And maybe not surprisingly, Ackman thinks the government should just acknowledge that it already got $301 billion in cash from Fannie and Freddie and simply waive or write off their liquidation preferences, and maybe the outstanding preferred stock as well. He might even have a point. The arrangement Fannie and Freddie have with the government is a bit like if you had to take out an emergency mortgage on your home in a crisis a few years ago, but the emergency mortgage was in the form of preferred equity, and every time you make a mortgage payment, all of it just goes to the lender as a dividend, and you will never, ever be able to pay down your loan. Even worse, if your house goes up in value, like Fannie and Freddie making a profit as companies, the increase in the home value gets fully credited to the government as well, increasing your mortgage in the form of a liquidation preference, so to speak. So yes, you did save your home and are still living in it, but you're essentially in a hamster wheel. Whatever you do, the government gets all the upside and you'll never, ever get out of it. As I said before, that can sound harsh, and perhaps it is, but these are the current terms of the bailout. And remember, Fannie and Freddie agreed to these terms because they were essentially bankrupt and had no choice back in 2008. The fact is, without the bailout, without the government and these harsh terms, there would probably be no Fannie or Freddie to speak of today. Beggars can't be choosers, and all the courts of law that have been asked in the past to look at the arrangement have said essentially the same. Tough luck, but you were bankrupt and needed a bailout, remember? And they upheld all the conditions favoring the government. In fact, if you ask me, which no one has, by the way, but I'll give you my perspective anyway, like I usually do. While I understand and can appreciate these first two drivers for privatization, if there's nothing wrong with how the secondary mortgage market is working right now, if everything is humming along nicely, and if all the profits that Fannie and Freddie are churning out go to our federal government, who, by the way, needs every dollar and cent it can get to manage our budget deficit, then why change anything? And the more pressing danger in my mind is this. In the good times, when Fannie and Freddie are profitable, we privatize, as has been done before. In the bad times, we bail them out, as has been done before as well. And that doesn't necessarily sound like a good deal for America. It appears we're back to the good times right now, at least for Fannie and Freddie. And not surprisingly, we're also back to the privatization discussions again. You see where this is going. That said, based on what we know now, I don't think there is a huge immediate concern for agency bond investors at the moment. Let's talk about why. What happens next, and what should agency bondholders do now? So here are my takeaways from the analysis that we've done from this two-part series on Trump and your agency bonds. 1. Don't worry about any Fannie and Freddie loans and or bonds you currently own. They will keep their implicit guarantee, and we assume this will not change. Remember, the last time Fannie and Freddie needed that implicit guarantee in 2008, the government did step in, and we suspect they would do the same if it was ever needed again in the future. Fannie and Freddie are still as important as ever to the functioning of our housing and financial markets, and maybe even more so in times of higher interest rates. Also, don't worry about your other agency bonds that are not from Fannie Mae and Freddie Mac, because at the moment, the media discussions about agency privatization have been limited to just Fannie and Freddie. 2. Keep watching the space, but don't expect any immediate action. As we've already shown you, it's complicated, and any proper privatization or any other move will take time. Plus, we don't even know where Trump stands on this and how important it will be for him to make it happen. It's clearly about a lot of money and high profile, so we would expect any real action to happen only if Trump himself gets behind it. And the driver for this would need to be more than to make some rich folks even richer. And of course, we're going to monitor events here at Diamond NestEgg for our community so that you can be among the first to know if a new development comes about. And 3, if you're now tempted to buy some shares in Fannie and Freddie to participate in the upside in case Ackman is successful with his push for privatization, remember, all of this is highly speculative and unlikely to happen overnight, even under the most favorable scenario. At the time of this taping, Fannie and Freddie shares have already gone up more than 4.5 times since Election Day. Even if Ackman sells tomorrow, hypothetically, and never mentions privatization again, he would already have made a handsome profit. So who knows, but we might see this privatization discussion lose some steam and urgency pretty fast as well. Drop a comment below though. Are you tempted to dip your toes into Fannie or Freddie shares? What do you think about privatizing them again? And would you continue to buy agency bonds if there was no implicit guarantee? All right, members, super savers, and bond course fans, I hope you enjoyed this deep dive into the colorful history of the secondary mortgage market in the U.S. and that we've helped you separate fact from fiction in a clear, concise manner. As always, if you want to really get up to speed on bond investing and building out your bond portfolio while rates are still quite attractive, then check out this video here on our beginner and intermediate bond courses, which we are in the process of updating. Use coupon code BONDS2025 to get an additional 10% off of our popular bond course bundle before the end of January. The 10% coupon code BONDS2025 can also be used to purchase Bond Beginners or our intermediate level course Bond Masters individually. And as a reminder, our next Bond Beginners live course session will be on Sunday, January 19th at 5 p.m. Eastern Time, 2 p.m. Pacific Time, where we'll be diving deeper into this month's 20-year T-bond and 10-year TIPS auctions. And our next YouTube member live will be on Sunday, January 26th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into this month's upcoming 2, 5, and 7-year Treasury auctions, and all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. See you again very soon with more brand new wealth building content for your financial journey.